Views regarding the economy, securities markets, or other specialized areas, like all predictors of future events, cannot be guaranteed to be accurate and may result in economic loss to the investor. Past performance is no guarantee of future performance. Any information is for illustrative purposes only and is not intended to serve as investment advice or as a recommendation, since the availability and effectiveness of any strategy is dependent upon your individual facts and circumstances. Individual securities discussed may be held in accounts where JGUA and or its employees have a beneficial interest. And with that, let's get to this week's episode.
Hey everybody, Dr. B here with John G. Ullman and Associates. This is our weekly market update for the week of March 3rd. I want to thank you for joining us. I also want to encourage you to like and subscribe to the channel if you find these videos helpful. As usual, my goal with these videos is to use my background in economics to help you better understand the economy and the financial markets so you can make informed financial decisions. So with that, let's get ready to hit the books and get up to speed on the markets. As usual, we'll start with last week. So of course, one of the big headlines for last week is the Department of Government Efficiency and government spending. So DOGE, by the end of the week, claimed to have reduced government spending by about $65 billion. They did this through ending contracts, freezing funding, and laying off workers. The $65 billion value has been called into question by some investigative journalists and media outlets, but given the lack of transparency, until we have more information and concrete data, it's a bit difficult to identify what is or is not a legitimate cost savings. We also saw last week the House of Representatives passed a new budget resolution that included $4.5 trillion in tax cuts, as well as $2 trillion in budgetary cuts over the next 10 years. Now, inevitably, reducing taxes by more than reducing spending means it will increase the national debt. And this budget resolution actually included an additional $4 trillion increase to the debt limit. It's important to mention that tax cuts typically stimulate the economy and tend to lead to greater inflationary pressure, while cuts and reductions in government spending tend to slow the economy down and tend to create increased unemployment pressures. The big question moving forwards is which of these pressures and which of these actions is going to dominate the economic outcome? And is it possible that we could see both increased inflation and increased unemployment and an unfortunate situation that we think of as stagflation? Switching gears to the macroeconomy, we saw the second revision for the fourth quarter of 2024 real gross domestic product, and it came in almost exactly the same as the first reported value. GDP increased by about 2.3% in the fourth quarter, which was less than the 3% we had seen in the second and third quarters, and the overall increase in real GDP for 2024 was about 2.8%. Last week, we also saw the Personal Consumption Expenditures Price Index for the month of January released on Friday. The results of the inflation numbers were in line with expectations. The headline inflation increased by about 2.5%, while the core inflation increased by about 2.6% in the last 12 months. The big shock coming out of this report was a significant drop in consumer spending. Consumer spending dropped in the month of January by about $30 billion, which was the largest drop since February of 2021. Ultimately, personal income rose, the personal savings rate rose, but the personal expenditures fell. What this suggests from an economic standpoint is that although consumers had a little bit more money, they chose to put that money into savings as opposed to spending it on consumer goods. This suggests that the uncertainty and the fear of the future economic situation may actually be translating into less money spent, which ultimately becomes less revenues for businesses and potentially an economic slowdown. Along with the reports on inflation and GDP, we also saw the Conference Board's Consumer Confidence Report early in the week. Unfortunately, the results of the report were not incredibly positive, as the overall confidence index dropped by the largest amount we've seen since August of 2021. We also saw the Consumer Expectations Index drop into the potential recessionary phase for the first time since June of 2024, and we saw consumers expressing significant concerns with a tightening labor market, future labor market troubles, future family income and financial well-being troubles, as well as future business concerns. Switching our focus to the stock market, we saw a significant drop in all three of the major stock indices last week, with the NASDAQ leading the way down. In line with those results, the Magnificent Seven stocks continue to lag the larger market. Specifically, last week, we saw the earnings report from NVIDIA, one of the largest tech companies in the United States and the world, and we saw their fourth quarter earnings came in relatively strong, but market skepticism and concern with ongoing issues such as inflation, tariffs, trade wars, and now the potential for an economic slowdown seem to dominate the results more than a strongly optimistic NVIDIA earnings report. In the last few weeks, we've seen several companies reporting a growing concern with a slowdown in consumer spending as part of their fourth quarter earnings reports. Matching this with the personal consumption expenditures decrease in consumer spending, what we saw throughout last week was a significant shift in concern from the possibility of future inflation to the possibility of an economic slowdown as well as future inflation. One market we saw this play out in was the bond market. Specifically, the yield on the 10-year Treasury note dropped to about 4.2%, which is the lowest that it's been so far in 2025. We saw the investors in general shifting focus from a growing concern about inflation to a growing concern with economic slowdown as a result of a pullback in consumer spending and potentially a worst-case scenario of stagflation, where inflation and slowdown occur simultaneously. Switching our attention to alternative markets, we saw the price of oil drop again for the sixth straight week. We saw the dollar get a nice boost towards the end of the week as the Trump administration reiterated and emphasized the resumption of tariffs on Canada and Mexico, as well as new tariffs on China that should begin on Tuesday of this week. We also saw the price of gold dropping as we saw significant shift in investor sentiment from the gold and commodities markets into the treasury markets. Last of all, it was a brutal week for the crypto and Bitcoin markets. The crypto markets fell across the board. Bitcoin actually saw its price drop below $80,000 for the first time since November of 2024. In general, the crypto market took a hit as concerns about economic slowdown took their toll, and a major hack at Bitcoin derivatives exchange Bybit also caused concern and reduced some faith in the security and confidentiality of the crypto markets. Switching our focus to this week, we start with fourth quarter earnings season, which, as it continues to wrap up, we'll see about 10 companies reporting this week and about 10 more reporting next week. The big headliner for this week is tech giant Broadcom. Broadcom was actually part of a larger discussion last week about the potential breakup of Intel, where Intel's chip manufacturing and chip design functions would be split up, with Broadcom acquiring the chip design functions and Taiwan Semiconductor acquiring the chip manufacturing. At this point, this is still just skepticism. This is potential discussion of a possible deal, but there is no tangible physical deal in place. This week is also jobs week. As we move through the week, we'll see all the typical unemployment reports, including the JOLTS, the ADP employment report, and the national unemployment report on Friday for the month of February. The importance of this week's jobs report is that if we are already seeing a significant pullback in consumer spending and economic slowdown, we will most likely start to see indications of that in the unemployment reports themselves. Last of all, for this week, we have to take a minute to talk about tariffs. Last week, President Trump mentioned additional 25% tariffs on goods and services coming from the European Union. And on Tuesday, the 25% Mexican and Canadian tariffs are set to go back into place, as well as an additional 10% tariff on Chinese-made goods. As we move forwards, the market has grown somewhat skeptical of the actual legitimacy and long-term implementation of these tariffs, but should we see Tuesday's tariffs be put in place and remain in place, this could potentially change how the market and how economists think about future trade policy going forwards. Along those lines, we can shift our focus to what we're watching going forwards. Although tariffs and inflation continue to be a concern, as we saw towards the end of last week, the new headline concern is the potential for a major consumer spending pullback and a resulting economic slowdown. As these concerns about economic slowdown continue to take shape and unfold, we'll be watching closely how the data and the surveys indicate a shift in sentiment. As of right now, it looks as though both consumers and businesses are growing increasingly concerned about both the instability of the economy, the financial markets, and government policy and operations going forwards. This is one of the reasons why we're watching DOGE and the ongoing government spending and employment reduction efforts very closely. The United States government is the single largest employer of American citizens nationwide, and the government spending makes up about 20% of our GDP. With large and unexpected cuts to both employment and spending, it's possible that we could see these reductions trickle down through the economy and exacerbate what seems to be an increasing level of uncertainty and economic slowdown. It's important to remember that cuts to government spending actually function with a multiplier, so the ultimate impact of these cuts tends to be greater in the grand scheme of things than the initial cut itself. It's also important to remember that government employment does not just occur in Washington, D.C., but occurs all across the country. So while a lot of the government reductions in employment have occurred in the D.C. area, we expect to see employment reductions nationwide across nearly all 50 states. This week's labor market data, although it won't be comprehensive, will be incredibly important to watch. As one thing we know about unemployment is that unemployed workers tend to spend significantly less. They also tend to be more likely to miss payments and fall behind on their debts, such as their mortgages, car loans, and credit cards. It's possible that a significant unexpected increase in unemployment could result in increasing turmoil in both the housing and financial sectors moving forwards. As we all know, unemployment is never a good thing. Unfortunately, government unemployment is no different than private sector unemployment, in the sense that these workers, who are also consumers, will have less money to spend and will be more likely to potentially miss payments or default on their consumer debt, such as their mortgages, car loans, and credit cards. With this in mind, it's possible that a significant increase in unemployment could result in significant damage to both the housing and the financial sectors. I want to take a minute to mention the fact that I realize that this week's report is a bit of a downer. A lot of what we're talking about has negative connotations and is concerning to quite a few people, consumers, analysts, and investors alike. We've seen a lot of economic uncertainty going forwards, and I'd like to take 1 minute just to mention the fact that this is why we created this show. The weeks that we get to share positive, strong economic information are great, and we enjoy producing those shows. But part of the reason that this podcast or video is so important is when things start to get tough. There's going to be a lot of data and a lot of opinions and a lot of reports over the next few months. And what we're going to do is what we do best. We're going to filter through it all, and we're going to do our best to bring you information that's helpful in an understandable way so that you can stay up to speed on the markets. It's important to us that we help you, as well as anyone else who may stumble upon these videos, navigate what seems to be a challenging future economic environment. So with that said, I want to thank you for joining me, and I want to encourage you to join us again next week as we continue to filter through the information and keep you informed on the economy and the financial markets. Thank you, and have a great week.